morning, everyone. Thank you for attending today's webinar on how R&D tax credits can benefit your business. My name is Jamie Brandis, and I'm the Program Manager for the statewide Colorado SBDC TechSource Commercialization Program. We're presenting this webinar in partnership with the Southwest Colorado SBDC, which is based out of Durango. Normally, we would host this presentation in person as part of one of our innovative business road trips around the state, but due to the current situation with COVID-19, we've moved these presentations online. We hope to be able to meet everyone in person next year. I would now like to introduce Mary Shepard, who is the Director of the Southwest Colorado SBDC, to tell you a little bit about their center.
Hi, thanks everyone for joining us this morning. Again, my name is Mary Shepard. I'm the Director of the Southwest Colorado SBDC. We are one of 15 centers in the state of Colorado, and we cover the 5 counties and 2 tribes down here in Southwest Colorado. And we offer free one-on-one consulting and trainings and workshops to the small businesses down here. We partner with a number of the other business development organizations, and we have been working hard not only to provide some recovery consulting, but also for the new businesses that are coming and the existing businesses. So reach out to us if there's anything that we can do to assist your business. And thanks for joining us today.
Awesome, thanks, Mary. So now I just wanted to tell you a little bit about the statewide TechSource commercialization program. We provide assistance with primarily SBIR and STTR, as well as advanced industry grant opportunities for early stage seed funding. So all of these are grants, so you don't give up a piece of your company. It's non-dilutive funding. SBIR stands for Small Business Innovation Research. So we're happy to explain that more if you're interested in working with the program. We also help with technology commercialization and go-to-market strategies. We help with IP protection and assistance with the patent process. Additionally, we help with market research, market sizing, as well as strategic and tactical planning for your business. And now we also focus on R&D tax credits, like we're speaking about today. And finally, with the current situation, we're also helping with tapping into COVID funding programs. So primarily, we work with Colorado-based science and technology businesses. Some of the sectors that are included are advanced materials and manufacturing, aerospace, agricultural technologies, bioscience and medical devices, information and communications technology, energy and clean technologies, and other innovative technologies. So whether or not these seem to apply to you, many businesses do have innovation within what they're doing. So we're happy to talk with you, see if you're a good fit for the program. So what we offer is no cost, customized confidential consulting. We also do in-person and live stream workshops. Like I said, pretty much everything is online right now because of COVID, but we try to be in person whenever we can. We do some special events and conferences. We have some accelerator programs. And then we also have some online communities for resources and connections. We're currently on Facebook and LinkedIn, if you just look for TechSource. So we are able to offer the consulting program and resources at no cost, thanks to support from SBA's FAST, which stands for Federal and State Technology, and that is a grant that we receive. We get some funding from Visa, as well as the Colorado Minority Business Office, the Colorado Office of Economic Development and International Trade, as well as the company Zero. Please note that everyone is currently on mute. So I'm going to open it up to Q&A at the end of the presentation today. I ask that you enter your questions into the chat bar, and then I will moderate those questions with Thierry at the end. We will be recording this webinar today, and we'll share the recording with you afterwards. We plan to send an email, so you'll have links to everything. So now I would like to turn it over to our presenter, Thierry Lapoutre.
Thank you, Jamie. So hello, everybody, and thank you for attending. As I was saying to Jamie, I'm very disappointed I'm not there in person. I was looking forward to being able to do a trip over there, but I'll make sure to be there next year. So I've got, my presentation is going to last about 30 minutes. My objective in this presentation is that you know coming out of this, if you qualify for this program, and how much you can get back from this program, and have a general idea of how to go about getting these credits or this cash refund. Okay, and what I'll do is I'll explain who can claim, what's eligible R&D activities, what are eligible R&D expenses, explain how to apply for it, and do a calculation for you of how to get, of how much you're going to get back, and how you get that cash back through your tax returns. So first, a little background. I'm an engineer, and I've been doing this for over 20 years. I had a large firm back east, and had over 60 employees, and all we did, just to give you an idea of how much work there is to be done in this, is we had 60 employees all doing only R&D tax credits. I moved to Colorado in 2016. At that point, I had sold the company already and started Booster Consulting. And since then, pretty much since as soon as I got here, I started working with the SBDC. And we now have 20 or 30 clients that we've worked on together with some amazing results, and 100% success rate in terms of claiming these credits and obtaining them. So why is this important? The IRS will refund you up to 10% of all your R&D expenses, okay? But, and this is from the IRS's own estimates, more than 80% of US companies are not taking advantage of it, okay, for a number of reasons. So I'll go to the next slide, Jamie. So what is it? It's a federal, and mainly I'm talking about the federal now, and you'll understand why when I get into the Colorado. It's a tax credit available to any company doing R&D. It's usually cash, normally applied to income taxes. But if you're a startup, within your first 5 years of gross receipts, you can turn this tax credit, because you're assuming you're not paying taxes, and turn it into payroll taxes credit if you have employees. So in most cases, this tax credit is a cash refund. The benefit on average is about 8% of your R&D expenses, ranging up to 12 or 13%. You can claim the current year in your, well, let's say the current year is 2019, as well as the previous 3 years, as long as it's 3 years after the date you filed your tax return. So most companies now can still go all the way back to 2016. And finally, as I mentioned, Colorado has its own R&D tax credit that I'll touch on at the end of the presentation. It's just not as advantageous as the federal. So who can claim? Basically, the answer is anybody. C Corp, S Corp, LLC, individual, partnership, organization, trust, or estate, as long as you're not a charitable or not-for-profit organization. The company can be in any industry from textile to aerospace, but the requirement is that you conduct eligible R&D activities in a field of technology, and I'll touch on that coming up. And finally, your costs must be incurred in the US, the costs that you're claiming. So you could have a team here or the owner here with a software development team in India. What you can claim is the expenses here, not the out-of-country expenses. So now that you know, okay, I'm doing R&D, how do you claim? So the first thing is you have to identify your eligible R&D activities, okay, the ones that, according to the government, meet the criteria. Then you calculate your R&D expenses tied to those eligible activities. And then you fill out what's called a Form 6765 and any state claims and file with your tax returns. And finally, you organize your backup documentation to justify what you're claiming. Okay? So the first step is what are eligible R&D activities? There's a 4-part test that the IRS came up with. So, and it's pretty vague. The first one is it has to be in a field of technology. So it can't be in the social sciences or in marketing or in business. It's got to be physics, chemistry, technology, math. And it's got to be the development of something that's new in the company. So it's got to be a new product, a new process, or a new software in your area of expertise of your company. So you need to have background experience in that area. There needs to be a process of experimentation. You know, we all know what that is. It's, you know, come up with a hypothesis, do initial design, test it, rework, prototype, test the prototype, field testing. That whole process is essentially R&D. And during that process, you need to be eliminating technological uncertainty. So basically, you've got problems as you're developing technology. You have to rework, test, rework, and that's the process. So, you know, that's a definition, but essentially everyone's definition of R&D is generally correct. When you think of what's R&D, what's the process of R&D, that's what the IRS will recognize, whether it's in software or building a prototype in aerospace or a medical device. It's that process and the expenses incurred during that process that you can claim. I touched on the last 2 points, so we'll go to the next one. So, okay, you now know you've got a company. There's your own time. You've got an engineering team. You've got salespeople. So what can you claim? There's different buckets. The first one is wages. So it's the time spent by your employees on those activities that are eligible, and must be either doing directly the R&D, but it also includes the management time of supervising that team, as well as supporting activities. You know, for example, if you have to build a prototype and you need someone to come in and build it, some subcontractors, that's claimable also. Or you need some assistance from some non-technical people to do some of the documenting or some of the data analysis or testing of your software, that's also claimable. So, and allowable R&D activities, well, again, we all know it. It's concept development, feasibility analyses, prototype, tooling, design and construction, prototype testing, process validation, equipment design and development, final testing, including rework and modifications. So you see, it's really the whole gamut. And you know, the IRS's view on it is the same as, you know, the majority of people's understanding of what is R&D. There's also that 80% of anyone, if anyone's 80% or more time spent on R&D, you can automatically claim them at 100%. In terms of how do you determine those percentages? If you have documentation by job or by project, that's great. But if you don't, that's fine too. You can estimate, you know, by either, you know, if you have no other choice, then you can say, the best of my knowledge, 50% of my, you know, engineer is working on that project, or 20% of an owner's time, or 40%. Some estimates are fine, as long as you document the activities those people worked on. Next, supplies. So supplies that are claimable are essentially supplies that have been rendered valueless during the process of experimentation. So you're talking about lab supplies, test materials, molds, prototypes of all sorts, if they're rendered valueless, not sold to clients, and scrap from experimental runs. Any capitalized item is not claimable, no matter what it is. If it's been capitalized according to rules of accounting, you cannot claim it. And finally, land, property, equipment, so some lab equipment, your lab facilities, all those things are not claimable. Next, subcontractors. This is research conducted on your project by people that you're paying up through a contract to execute, and the rules for their activities is the same as for your own personnel, which is directly engaged, managing, or in support of an R&D project. You get less of a refund for subcontractors, but you're still claiming them. Then finally, there's also universities and research centers occasionally, and those you can claim those expenses also. And as a matter of fact, you get a higher percentage credit on those expenses. Now, those are all the research expenses that you've incurred, okay? And if it's internal R&D, meaning it's the development of your own software, or you're developing a new technology that nobody's paying you for, that's fully claimable. There's no question there. The question of funded research comes up when you're getting paid to do R&D, and this goes on a lot. In aerospace, it's pretty much every client claiming R&D has some has an issue of funded research that has to be looked at, as well as biotech, rarely software. So the question here is, who has the right to claim the R&D? So you've got the first party, and that could be the government, in the case of an SBIR, or it can be a private client that's paying you to do R&D. The question is, you need to determine if you are eligible to claim your expenses under that project. Now, in certain situations, you cannot, but in certain situations, you definitely can. So there's two criteria you have to meet. And the first one is that you need to retain substantial rights to the intellectual property. If we look at SBIRs, you always retain government contracts. The majority of the time, 99% of the time, you retain substantial rights to the intellectual property. Private clients, that's different. And sometimes in a contract, they'll specifically tell you that you're developing this for me, but you do not have the intellectual property. We're retaining it, and you have no access to this technology. In those cases, automatically, if you don't have substantial rights to the IP, you cannot claim the expenses under that. If you do retain rights, or if it's not mentioned in the contract, it's assumed you retain rights, then the next step is, do you have financial risk associated with this contract? Now, the R&D tax law has been around for over 30 years, and there's been a major evolution in this area. Initially, it meant that if you're getting paid to do R&D, you can't claim R&D tax credits on it. But it has completely changed over the years, and is really now in the R&D performer's advantage. And now, if you get paid a firm fixed price type contract where you've got a clear deliverable and product that you need to deliver to the client. So, if we look at a typical SBIR government contract, it's a firm fixed price, a phase 1, phase 2. It's a firm fixed price project with the delivery of a prototype, or at least a final report demonstrating how the prototype worked. And in that case, all the expenses under that contract are yours to claim. The wages that you spent on it, and the materials and supplies and subcontractors are yours to claim. Now, if we go to the other end of the spectrum, you've got cost plus or hourly type contracts. So let's say you've got a private client, and that private client is hiring you to do R&D. It's your technology, sure, and maybe the intellectual property, they don't mention it in the contract, so you're okay on that aspect. But then they're paying you by the hour, so you have no financial risk whatsoever. And in those cases, the hourly, definitely not. The Cost plus, definitely not eligible to claim it. And the cost plus fixed fee, in all those areas, the courts have ruled there's not enough substantial risk, even in some cases where you want to argue that you incurred extra costs. If it's those types of contracts, you cannot claim the expenses under those contracts. Okay. Next is we'll go to maximizing your R&D claim. And this one's kind of for companies that are already claiming. You need to know that aside from those specific projects, either internal R&D or firm fixed price client contracts, there's a whole bunch of other areas where you can, identify R&D costs. The first is bids and proposals. Your time spent on R&D, contracts that you ended up getting the contract. It was the initial steps of your R&D time, of your R&D project. Then G&A and overhead. In so many cases, I'll meet a company and start working with them, and then we find out that about 40% of their labor, or 10% or 20% of their labor, is not attributed properly to projects or internal R&D. It's just lumped into overhead. So you have to sift through that, and even if it's been lumped in as overhead, it's still claimable. Any internal R&D labor, so any project that you're taking on internally, you want to be claiming that. Prototypes, including prototypes delivered to the customer, if for the customer it's still a prototype. And finally, the all or substantially all, 80% or more. Remember that when you're making a claim, you've identified all your people's time from all these different areas, add up those percentages and check, one final check, is there anybody over 80% in there? And you can bump them up to 100. So now that you've identified your R&D projects, then you've identified your R&D expenses, what's the next step? Now, an R&D claim goes into your tax returns, okay? And they're entered at the federal level on Form 6765. There's a couple of different calculation methods. You should try both to see which gives you the better credit. You give that information to your CPAs, who then enter it as appropriate on your tax returns and choose whether to apply it as income tax credit if you're profitable, or if you're a startup in your first 5 years of income, you can apply it to your payroll taxes on your employees' Social Security, employer portion of Social Security taxes. You can get a refund on that. And as I mentioned earlier, you can file for the current year, but you can also go back and claim for the 3 previous tax years. Backup documentation. When I started doing R&D tax credits, this was a big issue because documentation was done on pieces of paper and people would throw it out, so nowadays it's never an issue. No financial or technical backup is sent in. So all you're sending into your tax returns is some numbers. The IRS doesn't know what's coming up with those numbers. So what you want to maintain is a couple things. One is how you came up with the percentages of different people, the analysis that you did on different expenses, and that's part of your worksheet that you've come up with to get to your numbers. And finally, if there is an audit of your R&D claim, you will need to show your technical work done. That would be either different versions of your software or your prototypes or reports on your projects. But that's rarely an issue. And on the topic of audits, there used to be audits. 10 years ago, we used to have, it was never a lot of audits, but I'd say about 5% of claims would get audited. But in the last 5 years, ever since the R&D tax credit became part of tax law in 2015, I have not seen a single audit. I've heard of some big ones, on big claims in the Bay Area, but here in Colorado, I have not heard of one. including on some claims that are a few $100,000 per year, including amended claims. And knock on wood somewhere, we're not getting any audits. So I'll go to the next slide, Jamie. So how do I use this credit? So this is your CPA that once you've identified all your expenses and fill out your form and your CPA has this, as I mentioned, you know, if you're profitable and you've paid your taxes throughout the year, then this R&D claim will generate a refund on your tax returns, because all of a sudden you get a tax credit and you paid all your taxes. So within a week or two after filing your tax returns, you'll get that refund for current tax years. For amended years, again, assuming in those amended years you paid taxes, so you're going to want to go back and claim the previous years, then it takes 3 to 4 months before you get your refund. Okay? That's for profitable companies. If you're a startup and you're not profitable, again, we've talked about this, you're going to apply it to your payroll taxes. Now, the way this works, it's a little complex, but in that form that you're filing your R&D tax credit, you're going to say, I choose to, because I'm not profitable, I choose to apply this R&D tax credit to my payroll taxes. So in the following quarter, at the end of that following quarter after you filed your tax returns, in there, when every quarter you file Form 941, in that Form 941 now, since a few years ago, there's a line 11 that says, Form 941 is where you're saying, I paid this much in payroll taxes. This is what I owe in payroll taxes. Sometimes there's an adjustment there. And then you'll have, oh, and I'm claiming an R&D tax credit. So, you know, you apply as much as you can of the tax credit to get that whole amount refunded. And within a few weeks, you get your check back from the IRS for your payroll taxes. And you keep doing that every quarter until you used up all your R&D tax credit. And it works great. It works every time. It's a little complicated to go through those steps. But as I said, every single one of our TechSource clients, it's worked every time on every one of them. If you're unprofitable and you're not a startup anymore, you can still claim, but you can't use it. The good news is you can carry it forward up to 20 years, and that goes in the books. And either you use it in some future year where hopefully you're profitable again, or there's another advantage to it that if you are selling your company, those tax credits are often interesting to the buying entity. I just have to go back for a second to payroll tax credits because I just remembered something. Payroll tax credits, that whole process, it's only available on current years. Okay, this is very important. You cannot do this, apply for the payroll tax credit on amended years, only on current years. So for you startups that were getting excited about this, but already filed your 2019 tax returns, unfortunately, you've lost the ability to apply it to payroll taxes. You'll be able to do it for 2020, but for 2019, if you filed your tax returns already, all you can do is amend those that year, but it becomes an income tax credit to be carried forward, but you can't use it until you're profitable. Okay, next slide. So finally, the Colorado R&D tax credit. You must be located in an enterprise zone. So I looked that up for Durango, and yeah, it's kind of a little bit outside of Durango, but there's a section of it on the northeast side that strangely, I think, includes a golf course. But there's a part there's a section that's part of an enterprise zone. And if you're in that enterprise zone, then you want to get certified because there's a number of benefits to your business if you are in an enterprise zone. And one of those benefits, there's employment credits and a bunch of other stuff, but one of those benefits is that you can also apply for an R&D tax credit to be applied to your Colorado income taxes. It's smaller, it's 2%, but the rules are the same as the federal, and there's not much extra work to be done. So if you don't know if you're in an enterprise zone, you just look up enterprise zone, Google enterprise zone Colorado, put in your address, and you'll know right away. And if you do, and if you are in one of those zones, then you should act on it and get certified and find your local. I'm not sure if everybody already does that. Okay. Yeah, that's it. So thank you, and yeah, I'll pass it back to Jamie.
Great. Thank you so much, Thierry. So we do have a few questions coming in, but if you have any questions, please write them into the chat bar, and I will try to get to them as well. So one person is asking, they have an LLC that until 2 years ago was a sole proprietorship. So the LLC did not file taxes until 2018. Does that mean they qualify since they had no revenues to the company until 2018?
So I'm assuming they're asking if they qualify for the payroll tax credit. So to qualify for the program, let me just touch on everything. To qualify for the program, whether you're a sole proprietorship or an LLC filing as an S Corp or an S Corp or whatever else, either of those entities or any of those entities, you can claim for the R&D tax credit, okay? Second is to be eligible, as I said, assuming you have R&D activities. Now, when you look at those R&D activities, as I mentioned, you have to look at wages also. And it's the wages, the W-2 box 1 wages. When you're an LLC, just be aware that a sole proprietor LLC, you cannot have wages under your company. Okay, it's kind of like it's just part of your personal. So there's not an actual, until you file as an S Corp, you cannot have wages. Okay, so I'm assuming here that you have expenses outside of your own personal time spent on that. Then those are claimable, and any wages that you have for other employees, that works. Okay, I hope that's clear. I've had situations where there's LLC, sole proprietor LLCs that are filing W-2 box 1s, and I don't really know what to say in those cases because they're not supposed to. So assuming that that's all the case and everything works there, then the question is, can I apply for payroll tax credit because I'm not profitable? So the payroll tax credit, there's a clock that starts. You're only eligible for 5 years, and the clock starts the first year that you have taxable income above $25,000. Okay, so if that sole proprietorship, I mean the LLC, once the LLC started, and if you still have no income under that LLC, then you're absolutely eligible for the payroll tax credit. And as a matter of fact, if you don't have expenses this year, then next year, that's the clock still won't have started next year. If you have no income in 2019, then year one will still only be 2020. So that's the good news. I hope that answers the question, because yeah.
Okay, thank you.
By the way, anyone's, feel free to send me an email directly if I didn't answer the question properly, or if one comes up after.
Yes, Thierry is one of our subject matter experts, so we can get you connected, and they'll do some consulting with you at no charge. So yeah, feel free to reach out. So another question is, does money paid to a U.S. company that uses offshore development qualify?
Okay, if I understand this right, you're hiring a company and their programmers, I'm assuming it's software, their programmers are not on US soil. Then the work done by those programmers would not be eligible, even if the company has an address here. Yeah. The question is are there people here that are doing part of the work? What I would do if that's the case, that there's some people here, a key person or a key architect or a key manager, at least claim a portion of it, the work that's done here.
Great. So you mentioned the opportunity zones. This person is asking if it also qualifies for the state program. I think you mentioned federal, but they're wondering if it's state too.
Sorry, I don't understand the question.
So you had mentioned the opportunity zones having the benefit. So they're wondering if it's both federal and state that you can claim credits for.
Yeah, you can claim this. First of all, it's the enterprise zone I mentioned. Opportunity zone I know nothing about. That's something else. So yes, you can claim both. Absolutely. The only requirement, and the federal, there is no requirement on the federal. You can be located anywhere as long as the work's done in the US, so in any state or property or territory. So you would claim federal in all cases, and for the state, only if you're located in an enterprise zone and that you're actually signed up and got certified in that enterprise zone.
Okay. So this person, I think they're just talking about what industries would qualify. In this case, it's a construction company, so they're wondering if they could claim.
Yeah, absolutely. So yes, for sure, construction companies can claim R&D tax credits and often do so. Typically, where you'll find claims for construction companies is either in their own development of tools or on complex projects where there's some R&D required. So I'll talk about a little bit about both. In some cases, the construction company, let's say an excavation or some other infrastructure, building, and come up with innovative ways to do the job faster or better, and will actually develop their own internal tools that aren't available, or they're too expensive, so they want to develop their own, version of it. And that work done, and typically a construction company like that would have, some engineers on the team doing that work, going through all those R&D activities of a prototype and testing and everything else, and that's fully claimable. And then there's the big infrastructure projects, often on civil engineering projects or excavation in complex areas where you need to develop new construction techniques and methods to be able to meet either the environmental conditions of that site or to meet the design specs of the crazy architect who designed the structure. When there's really something either in the type of concrete developed, or the appearance that needs to be developed, so some of the finish that needs to be done on a concrete surface, or some kind of structure that needs to look like it's unattached, but find ways to work with the metals and the supporting beams to make it able to do what the architect wants, or other ideas like that. Yeah, absolutely.
Great. So this is another type of industry that wants to see if they would qualify. It's a technology project with human health applications. They are a music therapist working with a small engineering team to develop adaptive instruments and software for individuals with physical and or cognitive differences.
So that sounds like a really nice R&D project. You know, at the outset, what you have to validate is, are there, you know, technical challenges there in terms on the software side, or on the, and I assume that there's different electronic parts or tools required to take certain signals and transform them. But at the outset, that sounds like a really nice R&D project. Yeah, absolutely.
Great.
Again,
so this person,
you know, yeah, whoever asked that question, you know, feel free to contact me and we can talk about it, and I'll give you the thumbs up and a higher level of confidence that there's technological challenges there, and that it's not purely on the you know, psychological or emotional side or the user interface. There's really some development work on the software, you know, beyond some basic elements. Yeah.
Okay, this person has a startup. They're currently in year 3 and unprofitable. So they're wondering if they can use the past 2 years for R&D tax credit if they have had R&D activity.
Okay, so year 3. So, and I'm going to assume here that they have not filed 2019. Okay, I'm assuming year 3 is 2019 and it's not filed yet. So 2017 was the first year of the company. The company is not profitable, and there were some expenses. Okay, 2018, again, some expenses, company not profitable, not paying taxes. So those 2 years, right now, if I look at those 2 years, I'm going, okay, I've got some R&D tax credits there, but unfortunately, I cannot use them for the payroll tax credit, meaning I'm not going to be able to get cash. All I can do is amend those years with my tax returns and with my CPA, and then have extra credits in my books. So what I would tell that company is, don't bother right now. There's no point right now in doing it. You have a year, at least a year, to decide that. Okay, because you can go 3 years back. So let's say you filed your tax returns, your 2017 tax returns in, let's say, June of 2018. You have until this year, next year, to decide whether you want to amend 2017. There's no point in doing it right now, okay? Because you don't know what's going to happen to your company. You don't. There's some expense and time, and you have to pay your CPA to amend the files and everything else. And then, so you don't want to do it right now. 2019, though, okay, but at least it's good to know that in the books of your company, you've got some tax credits, and to be aware, especially a year from now, once you start going, wow, I'm getting close to being profitable. Now's the time. Let's make sure we meet the deadline date, and you know, 3 years after the date we filed the tax returns, and let's go after those tax returns. Why not? Or maybe 2017 was so small, that was our first year. We only have a credit of about $10,000. Not worth amending, not worth going through that trouble. You know, so, but we know that we can go back and get it at some point. 2019, though, assuming you haven't filed your tax returns, now it gets really interesting. You want to file your 2019 tax returns, and you're going to apply that to your payroll tax credit. So even though you're not profitable, you're going to get a cash refund for the full amount of your credit, assuming that you have payroll, that you've got payroll employees and you're paying payroll taxes. Okay. Yeah, 2017 and the other thing is, assuming you did not have income in 17 and 18. So the other thing you have to figure out is, what was your year 1 for payroll taxes? It's So if you did have income above 25,000 in 2017, that would be your year one. Even though you didn't claim it, the clock started. And even though you cannot use it, the clock started the first year you had income above $25,000. So 2019 would be your year 3. If you did not have income in those years, then 2019, the first year you're claiming your payroll tax credit is your year 1. So you've got 5 more years of it and you're in a great position. But either way, you should be putting in an R&D claim. And now for 19, 17 and 18, I would wait till I know more. A year from now, once the deadline gets closed for 17.
Okay, so this person is a single employee S Corp. They mostly do TM contracts, but occasionally do fixed cost and internal. They don't have any expenses other than their own time. Is a simple time log of those activities enough documentation?
So I'll just do an overview. I think it's clear to this person what they can and cannot claim. So they're an S Corp, so single employee S Corp. So they're probably, the reason they're an S Corp is probably because they're paying themselves, decided they want to pay themselves wages. So, and let's just assume $100,000 in wages to themselves, okay? So there's contracts. There's 2 types of contracts you mentioned. Was some are hourly and others are fixed cost. So the hourly ones you cannot claim. Those are, you do not have financial risk on those projects. For the fixed cost projects, assuming you're doing R&D in that project and assuming that you did not mention IP, so I'm assuming it's not an issue, and if it's not discussed in the contract, then you retain substantial rights and it's not an issue. Then the fixed cost contracts, you have financial risk, and therefore you can claim your expenses under those projects. So then what you have to do, and I understand single employee, you're not keeping track of all your activities. What you can do is, either through the proposals of the different contracts or just some kind of analysis to go, to identify, let's say you have 3 fixed price contracts in that year. Try to estimate how much time you spend on each of those 3 relative to your total time worked. And maybe it's 10% of your time, 20%, and 20% for a total of 50% of your time on those 3 fixed price, something like that. Something reasonable like that can be more or less backed up through common sense analysis of the amount of work done in that project, and that would be, that's the approach I would use. Yeah. Again, there's no clear the guidelines from the IRS for timekeeping. Now you got to understand, if you've got a claim, if you're a large pharmaceutical and you've got a claim for $4 million of R&D expenses, it's one thing compared to if you're a single employee S Corp. The pharmaceutical, because of the large claim, has very high expectations from the IRS in terms of timekeeping, and especially in that industry, everyone's time is documented on a 27-step R&D process, and each one of those 27 steps. A single employee company is not going to spend time and is not going to put in a timekeeping system just for the sake of claiming an R&D tax credit. And then the IRS does not expect you to come up with an onerous documentation system just for the purpose of backing up your R&D claim. It needs to be a reasonable estimate of time spent using a reasonable estimation process. Whatever that is for each company differs.
Okay, so this company has several different questions about different activities they're doing. So in the first case, they did research with a U.S. company in the Bahamas on sharks. So they're wondering if that would be an allowable expense. Then they are planning research on the same technology with another species. And then finally, they're planning research with a different alloy for the same purpose for which their current is used. So in those three cases, would they all qualify, or are there differing aspects to those parts?
Can you repeat the first case?
Yeah, so research with a U.S. company in the Bahamas.
So you need to check with your CPA, but it's basically needs to be research conducted on U.S. soil. So you know, how much of it is I don't want to, you know, you'd have to check with your CPA.
Okay. And then they're planning research on our
and again, yeah, sorry, and again, related to, you know, those payments, you know, how much work is done in Bahamas, how much work is done on U.S. soil. Any portion of work done by a subcontractor that's on U.S. soil, including Puerto Rico, it is fully claimable. So if there is a portion on U.S. soil, yeah, so.
Okay. So it looks like they're also planning on doing the research for the same technology with another species and another alloy for the same purpose. So I'm assuming it's the same case where it depends how much is on U.S. soil, or would that be a different
in this case, I mean, in this case, you know, another species, another, you know, whatever variations there are to the R&D, or how many, you know, iterations there are, or you know, it's up to the company what they feel is necessary for their R&D. There's nobody going to question why they're doing the R&D. It's just, is there an experimental process and technical challenges? So in the case of testing like that, you know, there can be very, very significant levels of testing on multiple different, you know, field tests and just larger and larger kind of test groups. All those expenses are claimable because they're still considered necessary to validate the final, you know, conclusions. The only time R&D work, you know, or as long as it's R&D work, until you're selling that product, you know, after that, your expenses are considered not R&D anymore. But as soon as you get back to required testing to validate some more results, once again, fully claimable.
Okay, so this person is asking about they need to do one filing or two. In their case, they have one company that created a second company to be a fundable startup. The first company has people on payroll working on the startup, and the second company has one person on payroll. So should that all be one filing, or do they need to do two separate filings?
It depends. Okay, so and this comes back to funded research. Okay, so you've got company A and company B. Okay, so company A has got a bunch of expenses, so they should definitely be claiming R&D tax credits. Okay, now one of their expenses is making payments. From what I understand, if I understand this correctly, and Jamie, correct me if I'm wrong, but they're paying company B. Is that part of the question? Yes.
Yes, it looks like that. They created company B to be a fundable startup, is what they say.
Fundable startup. So if they are paying company B, okay, and then company B has some expenses, okay, so if there's no payments between the two companies, and you know, both what you're looking at is not where your income comes from, not what's your ownership structure. It's basically, do you have R&D expenses? And if in this case, company B has R&D expenses, which would be the payroll of that one person, then yeah, company B in their own tax returns makes their R&D claim, and company A in their own tax returns makes their own R&D claim. Now, if there is an exchange of money from, company A paying company B, which I think is the case here, so this becomes an issue of funded research. So if you're looking at company A paying $100,000 to company B, but paying them, on an hourly basis, almost kind of like a salary or a monthly kind of fee for their work done. Well, if you look at the rules of funded research, can company B claim their own expenses if they're getting paid hourly to do R&D? And the answer is no. They would not be able to claim their expenses under that contract, under those payments from company A. The entity that would be able to claim those expenses would be company A, because they're paying hourly $100,000. They're the ones with the financial risk. If there's more R&D, then they're paying more. So it would be company A, and in this case, B would have nothing to claim because they don't have a financial risk on that project. And company A would claim that subcontractor amount that they're paying company B, and therefore only one claim company A. And it make it easier also, if I understood that correctly.
Okay. So I think we have time for one more question, then we'll do a quick wrap up. So this person has a custom software company. Most R&D is done during the proposal process. So they're wondering if they can claim expenses even if the proposal is not accepted.
Right. So one of the requirements of an R&D project is that there's an actual R&D project, meaning that there needs to be a technical challenge and an experimental process developed and run to test those hypotheses and look at results. So in the case of business development, what I generally do is when you look at an R&D, the business development team or the main salesperson is when they're putting together their proposals, mainly that stays at a hypothesis stage. It does not go into an actual prototype being built and ideas being constructed and tested. It just stays really in the theoretical stage. So in that case, if it stays in the theoretical stage, there's no experimental process. There's no real technical challenges encountered and resolved or attempted to be resolved through experimental process. It just stays hypothesis. So in those cases, and that's why I said in the presentation, what we'll claim is the business development time on successful bids, because those then, that work done in the bids and proposal stage becomes hypothesis test, a development of hypothesis, which is an eligible activity as part of a R&D project, as the R&D project happens. If the R&D project doesn't happen, it's just hypothesis, but there's no experimental process and therefore no R&D. So unless you're really developing a prototype and really can demonstrate that you've resolved some of those uncertainties, then no, you would not be able to claim the business development time and proposal preparation time on a non-obtained contract.
Okay. Thank you so much, Thierry. I think this was really helpful. As a reminder to everyone, we did record this, so we will send it out in an email tomorrow along with Thierry's slides so that you have access to all of this information. We do offer consulting at no charge, like I mentioned. So if you go to SBDC-techsource.org, you can sign up for consulting there. You're also welcome to send me an email. I'll be on that email that we send out tomorrow. I'm happy to get you connected. I usually just do a first phone call, find out about your business, and connect you to resources from there. So Mary, did you want to have any closing thoughts here?
Yeah, thank you everyone for joining us today. Thank you, Terry. Thank you, Jamie. This has been super helpful. I did want to kind of go back on the enterprise opportunity zone question. Those are two separate things. If you have questions of where your business is located, you can also go to Region 9 Economic Development here in Durango, and they oversee our enterprise zone for our 5-county area, and they can help you get registered if you're not already. So reach out to us if there's anything that we can do outside of the R&D tax credit. We can help prepare, you to go and work with TechSource or work alongside what you're doing with TechSource. So we're here as well, and we look forward to working with you.
Great. Thanks so much, Mary, and thanks so much, Terry.
Thank you.